objective of Market Stalkers Level 2 is to familiarize a trader with market profile for the purposes of better timing of all your trade entries, regardless of whether they're swing or intraday, but Level 2 is designed with intraday traders in mind. However, in order to become a successful intraday trader, you must first gain knowledge of day trading time zones. I mentioned several times in Level 1 that even if you want to be a scalper, you still need to know when is the right time of day to execute a trade. So the subject of today's lesson is day trading time zones. In a typical trading day, there are rarely more than 2 or 3 directional moves that happen. What this means is really that there are 3 day trading time zones that enable the high probability opportunities for trades at least twice and sometimes 3 times throughout the trading during London and New York. So what is that all about? If you run your journals in a very detailed manner and then you analyze your performance over the course of several months, patterns will start to emerge that uncover these day trading time zones. And they represent times of day when counter trend moves usually start. And these time zones offer valuable windows when a particular strategy will have more chance of working out. So over the years, one of these time zones has kind of trickled down into the retail traders' minds, and that is that in the first 2 hours of trading, there are most opportunities. However, this is a slight misinformation because actually the first hour of trading in either exchange is usually the noisiest. And we will get to see why in the next lesson when I start to teach market profile. So, day trading time zones. Let's have a look at what these are. Starting with the Eurex Open at 7 a.m. London time, that is also the time when the Frankfurt Exchange opens. And it is also the time when fake-out moves happen. Because Frankfurt is too small an exchange, volume-wise, to actually break any significant levels. I've known a lot of new traders who get up at 7 a.m. and they execute a trade that looks like a momentum trade, only to get stopped out when the price reverses when London Stock Exchange starts trading. So that's the first thing to understand about this particular day trading time zone, that moves between 7 a.m. or 8 a.m. GMT, they are fake out moves, okay? If Frankfurt is trading the price one way, you can almost certainly expect the London to take it the other way. And I've also mentioned that the first hour is the noisiest. Sometimes the Frankie fake out, as we like to call it, it can last all the way till 9 a.m. London time. So it stands to reason that if you're looking for a momentum trade, you're likely not going to get it until after 9 a.m., until that first hour of noise is done. But of course, sometimes the moves do reverse post-Frankie fake-out only about 15 minutes into London trading. However, keep in mind that it is not just the time of day. You know, you cannot just get up every day and expect that this will happen each and every day. The location of the price in relation to Q points and to supply and demand zones and general chart positioning is also an enormous factor in deciding whether a signal that comes after Frankfurt is actually valid or not. And same goes for the other time zones too. So Frankie fakeout is time zone number 1. To illustrate this better, I've made a little flowchart to help you understand the process and timing behind the Frankfurt fakeout. So if you see Frankfurt Exchange opens at 7 a.m., so the trading begins, and then you have the fake out move that usually brings moves straight into like a daily or 4-hour Q point or possibly a relevant supply and demand zone. But then it happens to reverse that move after 8 a.m. GMT. So fake out move pretty much starts after 8 a.m. And then you go to monitor for reversal. You monitor the price action for reversal between 8 a.m. and 9 a.m. during the initial balance of London. If you don't get it, if you don't get the momentum, if you don't get the reversal pattern that you want to see, then you have to wait for post 9 a.m. Which means that you're then no longer looking for a potential Frankie fake out, but you're actually looking for a momentum trade that can last all the way up to noon. So post 9 a.m., once that first hour of trading is finished, you can look for momentum trades. So you monitor price action for momentum. When we start a market profile, you will know what to look out for. Okay, everything is very methodical, very systematic. But whatever happens, if you manage to catch a Frankfurt fake out reversal, or you manage to catch a momentum trade after 9 a.m., both of those are pure intraday setups. They're not swings. And then you will close all London trades by noon GMT at the latest. Okay? And by the end of this lesson, you'll know why that is as well. The second time zone is called post-NY cut. And it is to do with expiries of American-style options. Now, these, you don't need to know much about options at this point, but these American-style options expire every single day at 3 p.m. London time, which is about 10 a.m. New York time. After that, approximately half an hour to a full hour after the options have expired, there are opportunities to get in on the moves that are counter-trend to whatever is happening that particular day. And in some cases, if the price has reached a swing extreme in the shape of Q points, that is also a time zone when you'll be looking to get in on swings as well. If you don't know what Q points are, please go and revise the Market Stalkers Level 1, lesson number 3, and then it'll be clear. Now, the reason why this post-NY cut time zone is relevant, it is actually twofold. So there are two reasons for why this works. Not only do the options expire at 3 p.m., but also after 3:30 p.m. GMT, that is also the time when something called the initial balance of New York is over. You will get to know what initial balance is very well, but for now, just you need to remember that initial balance is the first hour of trading, and much like during the first hour of London, it is also the noisiest time for Wall Street trading as well. After 3:30 GMT, most of the volatility is over for the day. And that is exactly when the traders with big pockets, like institutions and hedge funds, they usually strike to get into their positions. And then by 4 p.m. GMT, there will also be a lot of traders that will get out of their positions for the day and take profit moves cause reversals in the market direction. If the price is at a particular swing extreme on medium time frames, this move starts at about 3:30 p.m. and sometimes later, but these moves can actually last for about 24 hours, sometimes even longer than that. And that gives us the opportunity for either a quicker swing trade or for a proper trade that can last 10 days. But it's got to be coming from a suitable spot in the chart. You cannot just take any position in the middle of Q points and then expect to run that for 24 hours, okay? I really don't have a specific flowchart for this because it's a straightforward process. Once 3:30 p.m. comes, start looking for reversal patterns. It doesn't really need a flowchart. It will be like a 2-box flowchart, so not very useful. Hopefully you can think in 2 decision boxes without the need of a flowchart. The third time zone that you should be looking at for trading is the day range fill. This time actually mostly applies to equity indices and to crude oil. Sometimes Forex market can somewhat follow it too. But really the Forex reversal time is the post-NY cut, is the second day trading time zone. Day range fill is more for equity indices such as S&P, NASDAQ, even DAX and Eurostox. And the final reversal time when you should start looking for positions is at least 2 hours before Wall Street closes. But really, day range fill times do vary. Sometimes they will start from 6 p.m. GMT. Other times more like 7 to 7:30 GMT. I have never really seen them start before 6 because that is the lunchtime. But I have seen them started at 8:30 p.m. GMT, which is half an hour before the close. And don't think that I'm like talking about like some tiny little move as well. Like this, look at this move. This was S&P. This one at the time was in a fierce downtrend. Like it was just falling off a cliff. And then it hit a strong H4 demand and it started to consolidate right above it. So it reacted, consolidated, and it then proceeded to turn, and it started the upward move by 6:30 p.m. already. This move went on for full 10 days. And here's the start of the move. That's what we were looking at zoomed in over here. And here is the end of the move, the end of the swing, 10 days later. And this is why I'm so vocal about my traders only starting swing positions during post-NY cut. It gives them a massive edge the next day if they know how to look for swing extremes. It doesn't apply if you're in the middle of Q points, only if you're at swing extremes. So let me say this again. You cannot go in on time zones 2 and 3 and then automatically hold them as swings, because most of the time these will only be good for intraday. Okay, they can happen outside of swing extremes, but if they're not coming from a larger area of a swing extreme, they're not valid for keeping overnight. They should be closed by 10 past 9, so 10 minutes after the Wall Street closes. That's your cutoff time. Even then, if you got a good move out of it, just take the profits and start fresh the next day. There's usually another way of getting back in on the swing once you're skilled enough. Now, a few more things that I need to explain regarding the day range fill. Why some moves start at 6 p.m. and others at 8. Traders usually head off to lunch between sort of 1 p.m. and 2 p.m. New York time, which is about 5 to 6 p.m. London time. And when they come back, they will start to get back in on positions, okay? Or maybe they will take positions that they already had from earlier in the day. And then come 8 p.m., which is 3 p.m. New York time, the bond market closes. And then all the bond traders, they flood the equities markets. So this kind of move is very obvious if you watch it on your futures ladders, and it will start to look like an increased activity on the futures ladder, okay? There's no real way to see this in Forex. This is only for those who trade futures. And then after this initial jolt, and then the trend turns, half an hour into it, about 8:30 p.m., so half an hour before Wall Street closes, then it's time for large institutions to rebalance their portfolios for the evening, okay? So that's two reasons for why sometimes moves will start sort of earlier, and then if the bond market traders have not actually done anything, then the rebalancing of portfolios starts at 8:30 p.m. Once I'm in on these moves, the day range fills, I will typically stay in until the market close for the day. I've made a career in using these, that's this last hour of Wall Street to run trades and get profits from it. And frequently, if I've traded before that, that will be the trade that bails me out for the day, if I haven't, and especially if I haven't managed to get in on anything else before that. Times of day not to trade. So this is equally important. we're definitely talking about lunch times. So you got to apply some common sense. Again, a lot of people insist on trading the noon in GMT, and then they trade 5 p.m. to 6 p.m., completely forgetting what the routine of the traders actually is. They have to eat, right? So they have to go out and do their thing. And during that time, there's a lot of reversals and fake outs that happen, and a lot of people get caught out. And they look like the market is turning, and then signals fail, and then you're staring at a lost position. So you've messed up. You didn't trade the correct time zone. So save yourself a lot of cash and sit these out. Initial balance time. Another time zone where I suggest that you don't trade. Initial balance is the first hour of trading. Like I mentioned before, you will get to know this terminology incredibly well over the few coming lessons. During the initial balance, you can expect lots of twists and turns, and that is the liquidity makers doing their thing. They're pinging the prices in relatively kind of small but very volatile ranges, and many new traders get their faces torn off during the initial balance. I myself, I find it way too stressful. I like to trade off of my 30-minute charts, and I rarely trade it, to be honest. I'm usually at the gym at the time. But I have traded crude oil during the initial balance, like just very quick trades, especially if I see acceptance of value on crude oil, then it can be a very good quick trade if you get in on it sort of within the first half hour. But again, more on that in level 3, because I think this is going to be a little bit over your head. Like, there's so much to go through in level 2. But when I trade S&P or Euro USD and any other forex pair or equity index, it's been a very long time since I've actually kicked off a trade before the NY cut for my afternoon trades. So please avoid doing momentum trades during the first hour of London and during the first hour of New York, of Wall Street. While I'm on the subject of times of the day when not to trade, I would also highly suggest avoiding trading before London open in general. So no trading during the Frankfurt fakeout. Spend that time, 7 a.m. till 8 a.m. in the morning for us European people in London. Spend that time in bed or preparing for London trading. But do not trade. Like, review your levels. Set stuff up. Make scenarios for the afternoon trading. Do not trade during the Frankfurt Open, okay? So what we can conclude out of all of this is the following. Markets constantly play a game of cat and mouse. Frankfurt fakes London. So if London takes it one way, so if Frankfurt takes it one way, London is going to take it the other way. If London has been going one way, then New York will take it the other way. And finally, if New York has been going one way, Asia is going to take it the other way. And then back from Asia/Frankfurt back to London. So it's the constant kind of game of cat and mouse. Whatever one session does, the other will slightly reverse it or completely reverse it. And complete reversions usually happen London versus New York. So London will take it up, New York will drag it all the way back down and then some. So knowing this, try not to get caught out in these fake outs when you're in a swing. I've had new traders who started trading swing and they want to observe the Asian markets or Frankfurt fake out or London. For example, if you've caught a nice swing from, let's say, a Q low daily chart, and then now you have a nice follow through that ended the previous day in a bullish engulfing, like a really strong bullish engulfing candle, and then you wake up, too early, slightly too eager to see what's happened with the trade, and you see that Asia has begun to retrace about half of the move back to the conterminous line of the bullish engulf. But please hold off with your twitchy fingers and wait until you see what London does with it. And finally, also please make sure that you clearly start to differentiate between your planned swing trades and your planned intraday trades. No mixing. You cannot start an intraday trade from middle of nowhere and then decide that you'll turn it into a swing. Make sure you know which time frames you base your setups on. Is it a 4-hour setup or is it a 30-minute setup? And then by knowing that, please also know your trade life duration, which is, I always say, it's 8 to 12 periods max. When I say periods, I mean candles. Meaning that if you base your trade on a 4-hour candlestick pattern, then you have between a day and a maximum of 2 days to trade, to let the trade reach the target. If it doesn't reach it in that time, take it off the table wherever it is. You have to have a cutoff point. You have to have clear exit strategies, and this brings me back to, I think it was a trading plan creation lesson from level 1, where I tell you not to hold trades for too long, because the longer it takes for a trade to reach the target, the less likely that's going to happen. If you've taken a setup from an M30 chart, then you're really looking at about 2 to 6 hours maximum, based on the 8 to 12 periods maximum trade life. Both of these trade setups can come from the same Q low area on a daily chart, but because the stop sizes will be vastly different for 4 hours and for M30 setups, that should also translate into your trade life expectancy. Okay, so that's it for the typical trading day and the time zones, and I will see you in the next lesson when we start the task of learning about market profile, which has a whole dedicated 3 lessons in the course. Thank you for watching.